Hello, everybody. Welcome to another episode of the Olympus Wealth Strategies podcast, where we help you take your finances to great heights. A lot of people have been talking about topics that we can discuss as it relates to market volatility. And so we made that happen. And with us today is the director at Pacer, Sean O'Hara. He's got a very storied background, and he's going to be able to go over a topic today that I think resonates with a lot of investors. So, Sean, thank you so much for making time and coming on the podcast.
It's great to be on. Thanks, John.
Good deal. Well, we always like to get to know the person behind all the knowledge. So can you just take a couple minutes and tell us about yourself?
Sure. 40 plus years in the investment business, mostly on the distribution side. Worked as a wholesaler, which I don't know if your audience knows what a wholesaler is, but a wholesaler is somebody that interacts with financial advisors and teaches them how different products fit into their portfolios. Then became part of management and then ran sales globally for a big insurance company, mutual fund outfit, and then left there and wound up as in the ETF business for the last 10 years. Now we started the ETF company 10 years ago. So I'm president of the ETF distributors and I'm part owner in the company. So been doing this a long time, been all over the country in 10,000, 20,000, 30,000 different towns over the last 40 plus years, talking to folks like yourself who give clients investment advice for a living and trying to help people build better lives for themselves, as you said.
Well, and we appreciate obviously what you've done and obviously what your team does today. So let's talk about buffered ETFs, right? It's starting to become a lot more, I'd say mainstream. I think more clients are starting to become aware of the name of this product, but I don't think a lot of people quite understand the mechanics of it. And so how would you describe a buffered ETF to an investor that's maybe either only heard the name or has never heard of it before?
Well, this idea of quote unquote buffers has been around a long time, whether it would be in a structured note or even in an indexed annuity or something like that. The evolution of the ETF has allowed us to create these strategies inside of ETFs. But essentially what it is it's a trade-off program, if you wanted to sort of simplify it. The way it works is, let's say your traditional sort of moderate buffer, which we would call a 0 to 15 down. Essentially what you're saying with that strategy is that if you're linked to the S&P 500, as long as the S&P 500 is not down more than 15% during the year that you own it, you won't lose any money. Now, the trade-off part of it is that you have to agree that above a certain number, you're going to forgo that return. So if the way we would construct this is we would first say, well, what do I need in order to buy the downside protection? And so say that's $1. Then what I need to do is go out and sell some of the upside on the S&P to somebody else to balance that out. So in today's sort of environment, you can look at a 0 to 15 buffer somewhere in the 12 to 14% range on the upside. So that's the bargain that we're making. And so for people who are conservative, who don't want to lose 30% of their money or 25% of their money, a buffered strategy can come in there and sort of give them that downside risk management that they're looking for. And most of those people who this appeals to are not necessarily, too worried about, if the market's up 30%. If you're up double digits over time and you have less risk to the downside, it becomes appealing to investors.
Well, and so if I understand you correctly, Sean, then what a buffered ETF is doing, as opposed to, let's pick on the S&P, for example. The S&P, we could be up 25%, we could be down 30%, and we just don't know, right? If we're just in an S&P ETF. But a buffered ETF linked to the S&P, what you're telling me is that we're effectively, throughout a certain time frame, locking in a range for your expected return. Is that accurate?
Yeah. I think you can think about it this way. So if you think about the return pattern on the S&Ps, at one end of this sort of bell curve, you have the disastrous sort of tail risk events down 30, 40, 50%, right? And then on the other end of the bell curve, you have these magnificent returns like up 25, 30%, right? About 75% of the time on an annual basis, the S&P 500 is either down 0 to 15 or up 0 to 15. So essentially what we're doing is we're saying we're going to get rid of those tails. You're not going to have that nasty 50% down or 40% down. We're going to manage some of that for you. But you're not going to have that, oh my gosh, I'm a genius, I made 40% in the market this year. And so if you have an outcome that is going to give you the downside risk management that you want, and as much of the return of the S&P 500 as you can get, a buffer can do that for you. So like 75% of all the individual years in the market are going to fit between that 0 to 15 down and wherever the cap tends to be on the upside.
And so when this, throughout the evolution of buffered products, Sean, when the ETF product evolved, what would you say this really solved? Maybe what problem would you say it solved for both advisors and their clients?
Well, a couple of things. One is, the way you would have done this without an ETF is you might have done it in a structured note, for example, where you might have exposure to a bank's balance sheet, where you have to buy 1 year at a time, and so you have to sort of do all the work yourself. The other way to do it would be in an annuity, in an indexed annuity, perhaps. Let's say, there's a surrender charge, so you don't have the liquidity there, and then you have ordinary income tax. And so what the buffered strategy in the ETF does is it gives you sort of a solution that you could just own and let it roll itself and not have to worry about capital gains taxes in the interim. And then ultimately, when you do take the money out, if you did, you would pay capital gains on any of the gains that you made, so you get better taxation. So it's sort of it really is kind of a revolutionary concept in that it provides a solution that's liquid daily, that you don't have to manage on a day-to-day basis. It'll roll itself automatically, and you get more preferable tax treatment at the end of the day.
So when advisors are looking at this, and when investors see this on their statements for advisors that use buffered ETFs, can you help us understand what this outcome period means? For example, clients, they've heard us talk about buffered series, whether it's for 1 year starting in October, ending in the next October. Can you help us understand really what that means and how that plays back into that range, like we talked about, of down 15 with maybe a cap of up 14?
Yeah. So every month we're going to essentially reissue a brand new 1 year buffered ETF. So it doesn't mean you have to hold it for a year, but the time horizon that we're going to be tracking the S&P is always going to be 1 year. Okay. So, we're in late March. So let's say April 1st, we'll issue a new one. And so between April 1st of this year and the end of March next year is your time horizon to be tracking the S&P 500. And that buffered ETF will either go up or down in value based on what the return is on the S&P. Now, it'll never go below zero unless the S&P has gone below 15% lower than when you started. So you always have this sort of that stable base, and then you'll see it appreciate a little bit over time. It won't track dollar for dollar what the S&P does. But at the end of the year, let's say that we had a moderate buffer with a 0 to 15 downside and a 14% cap. At the end of 1 year, if the S&P is up more than 14%, you're going to get 14% return, and you don't need to do anything. Then next April 1st, we'll issue a brand new schedule, if you will. You'll stay in the same ETF, so you just keep rolling these 1 year exposures internally in the ETF.
And which is very convenient for clients, like you mentioned, because then they can stay in the product knowing that in this example, every April 1st, they're
reestablish a new value. The new upside is going to be whatever the cap is. The 0 to 15 always stays the same.
Exactly. And so, Sean, how do these ETFs behave in different markets? I know you mentioned, if at the end of the time the S&P is up 15, then the investor, if the cap is 13 or 14, will receive that maximum value. But how do these ETFs throughout that duration of the year, how should investors typically expect them to behave, whether it's in up markets, down markets, or the market's trading pretty much sideways?
Well, I mean, I think, maybe the best advice I would give is to not pay that much attention to it. The thing that can sometimes confuse people about buffers is that if I buy in, I use my moderate buffer, 0 to 15 is covered, got a 14% cap on the upside. If in 3 months the S&P is up 5% or 6%, the buffer is not going to be up 5 or 6%. It might be up 60% of that. Because remember that the term on this is 1 year, and so anything can happen in the next, say, 7 months or 8 months. But at the end of the period, whenever that 1 year period is over, whatever the return is on the upside of the S&P 500, If it's not as high as the cap, you're going to get that. If it is exactly up what the cap is, you're going to get the cap. And if it's up more than the cap, you're still going to get the cap. Same thing to the downside. And so you won't see the ETF go down in value until you see the S&P 500 piercing that downside buffer, and then you'll start to see a moderate decrease until the end of that year as well. But again, if the S&P is down 20% during the course of that year and your buffer is 0 to 15, you lose 5%.
Makes complete sense. So we've got some clients who obviously implement buffered ETFs, and the question then when we talk about this initially always comes up: can you pop the hood on this and say what actually is going on underneath to create this downside protection with this upside cap?
Yeah, it's just a math problem, right? So we're using options, essentially they're instruments that we can use. And the options are, the first thing we're going to do is we're going to buy an option that protects us against the first 15% of the downside. And so that has a cost to it. And then just to make it simple, let's say it costs $1, right? So then we have to figure out how to then get that dollar back, because we don't want to just pay out the dollar, right? And so then on the other side, we do the math on, okay, what do I need to sell away to get $1's worth of premium back, right? So, and the option market would say, well, if 14 is the cap, if you're willing to give up everything over 14%, somebody will pay us $1 for that. And we match those $2 together, and so there's no net cost other than what the outcome of the ETF is. And so that's really sort of how it works. It's just a pure, simple math equation that we sort of do behind the scenes, and it's, we're going to buy the protection and we're going to sell some of the upside away, and we hope that what we're buying and what we're selling are equal dollar values so that everything balances itself out.
That makes sense. Now, when clients evaluate implementing these and advisors look at these, and obviously, we can't predict the future, but how do these typically perform? Picking on the S&P still, how do these typically perform compared to the underlying index, knowing that, like you mentioned, 75% of the time returns for the index fall, up 15 to down 15?
Yeah. So the difference is going to be that the S&P 500 is going to react differently than the price return of your ETF, because, those options have a 1-year time horizon. So options sort of accrue to the end, if you will, and then they sort of accrue to the downside and the other side. So if the S&P is up 5% in the first month, this is not, you're not going to be up 5%, you might be up 2.5%. But if the S&P finished at the end of the year up 5%, you would get that 5%. So you sort of have to take a step back and say, I just want this outcome. I want to know that if the S&P is down more than 15%, that the first 15% of that downside's covered. And I want to be able to agree that if I have to take a cap of 12 or 13 or 14% on the upside, that's a fair trade for me. And then ignore it during the year.
And so, Sean, out of all the advisors you've visited back in your day, and obviously the team that you help lead now, maybe what are some of the biggest misconceptions that you've heard and your team hears today about buffered ETFs?
Candidly, there's not a lot of controversy other than, they are still relatively new. The last 5 or 6 years has been really sort of the advent of this, but there's a new era sort of going on in the ETF business where, traditionally it would be like an ETF would be a basket of stocks or a basket of bonds. But the wrapper itself now allows us to create these payout schedules that normally would have been done in, a structured note or something like that. We do hear from financial advisors, like, how do I manage this? And should I manage this? Like, if I buy a 0 to 15 downside buffer and the cap is 12 and the S&P is up 11% in the next 3 months, I know I only have 1% more upside, right? But now I've got 27% downside. I got to go down 12 and then down the next 15. And so oftentimes financial advisors will actively take a look at that and say, you know what? Probably makes sense for us to swap this out, take our gain, increase our floor, put our downside back at 0 to 15 and move on down the road. Now, that can take time from the financial advisor's perspective. So now you're seeing the advent of sort of a fund of funds approach where, we own a whole calendar year's worth of these buffers at the same time. And that takes the work out of the client's hands and out of the financial advisor's hands so that they always know that every month they're getting a new exposure and every month one of the old exposures is maturing and paying out.
Which is, when you look at them, is pretty helpful, knowing that there's always going to be, like you said, new floors and new caps being set within that fund of funds. You kind of mentioned this, but I just want to drive this point home about just what clients should be mindful of, whether it be early. Maybe we could talk about selling early out of the fund before the period is over. We kind of talked about this, but from what you said, just to make sure our listeners truly understand, if they were to sell out of the fund before the outcome period, and I think we used April 1st as an example earlier. So let's say we're in, the better part of September. If the S&P is up 10%, they shouldn't expect it to be up 10% with it. And conversely, if the S&P is down, a certain level, then they should expect it to not track that. So I think just one point I want to drive home to listeners who aren't as familiar with buffered ETFs is, if you don't hold it for the full outcome period, you should not expect identical returns of that underlying index.
That's a very fair way to say it. Essentially, I'm buying an outcome over a year's time. And the way options work is, they don't track dollar for dollar up and down. Typically it's, roughly around 50%. So if we were into, say, 6 months in and the S&P was up 20%, let's say, and we might expect the buffer to be up somewhere around 10 or 11%, and then now it might be close to the cap. So, you just have to keep in mind that what you're doing is you're saying, for the next 12 months, this is what I want my return on this investment to be. I want the first 15% of the downside covered by somebody, and I want to be able to accept the cap on the upside of whatever the cap happens to be, 12, 13, 14%.
Now, how do you and your team and the advisors that you all talk to, how do you think of positioning buffered ETFs when we look at it within the broader context of clients' portfolios? What's maybe some of your insights on your thoughts there?
So there's really two ways to think about it. One is, like if you're an older client and you're starting moving to retirement phase, if you will, maybe using this as a replacement for some of your equity exposure, because at some point you're going to retire and you're not going to have any more new money to put into your portfolio and you're going to start living on it. So it allows us to manage some of that risk. So we see advisors, taking, like, if somebody's like 60-40 equity fixed income, they may take, 5 or 10% of the equity and use a buffer for part of that for those more conservative clients. And then the other way we see folks using it is as a replacement for fixed income, where, you buy bonds today and you get, somewhere between 3 to 5, maybe if high yield, maybe 7% yield. But you have risk associated. Like if you buy high yield, you got a lot of volatility in high yield bonds. Here you can sort of create a replacement strategy for some of that fixed income where you have some risk management to the downside and you're getting equity-like returns up to a certain cap.
As far as these structured outcome vehicles and buffered ETFs being the one we're talking about, how do you foresee this continuing to evolve and progress for investors? Whether do you start, Sean, do you kind of see that every index is going to have a buffered ETF, or do you think there's just going to be a lot new technologies and new new things to come with these defined products?
I think you'll see more and more elaborate versions coming out. I think you'll see them on multiple types of indices, whether it's not just the S&P, maybe the NASDAQ, maybe, emerging markets or international. I think there's going to be some of that. I think you'll see some more sophisticated payout programs coming. The structured note industry is a pretty large industry, and they've had a lot of different kind of unique payout versions in that market. I think a lot of them can be replicated in the ETF. So I think we'll see more and more of this type of product development in the next, 2, 3, 4, 5 years.
Well, and since you mentioned that, and so maybe for the advisors listening, and certainly for clients who have experience throughout time with structured notes, can we take a moment just so they can understand really the difference between the buffered ETF option versus the structured note?
Yeah, I mean, you essentially could buy a structured note that had an identical payout, let's say, to the ETF, right? The difference is that structured note's going to be issued by a bank. And so essentially what you're doing is you're saying to the bank, I will accept on your balance sheet you saying you're going to pay me this outcome. Whereas in an ETF, we're actually owning the physical options inside, so you're not taking anybody's word for it. Those options do what those do. And so you have no credit risk, if you will, to the bank on that. The second big difference is that they all might have the same tenure, like 1 year at a time, like we are in a 1 year structured note. But then in structured note land, you actually have to physically do something on your own. You got to sell the note at maturity and then buy another one. Whereas in the ETF, it sort of all happens inside of the ETF for yourself. So it's more convenient. You don't have credit or balance sheet risk. And then you get favorable tax treatment. You're going to get capital gains so long as you hold it for more than 1 year versus paying ordinary income tax.
Which I think that's very important when investors are deciding that, especially for ones who are trying to manage taxes efficiently. Sean, this has been extremely insightful. Anything maybe that we didn't cover that you think would be helpful for our listeners, or maybe anything you want to leave our listeners with as we wrap up the podcast?
I think you did a really nice job of sort of digging into it, and I think it's a good service to your investor base. I think this is, the baby boomer generation is one of the largest generations ever in time. They've been a force to be reckoned with. Everywhere they went, from grammar school to middle school to high school to college, to their consumption. Now those folks, 10,000 of them a day, are retiring or turning age 65, and so this is a big opportunity for those folks to sort of rethink their portfolios. And manage the risk in a way that may not have been available to them in the past. So it's a great time to be thinking about things like this and to be in this business. And I think you're doing a service to people by bringing it up and letting them know that these things are available.
Well, we appreciate that, Sean, and obviously we appreciate everything you and Pacer does and how you guys help us with great insights and products. And we appreciate our relationship with you. And for everybody, we will see you on the next podcast. Thank you so much.
All opinions expressed on the podcast by the host and guests are solely their own opinions and do not reflect the opinion of Olympus Wealth Strategies or Uptick Partners, a registered investment advisor. This podcast is for educational purposes only and is not legal advice and should not be relied upon as a basis for any decisions. The investments discussed on this podcast may not be suitable for all investors and involve risks that should be carefully considered. Listeners are encouraged to consult with a qualified financial advisor before making any investment decisions. Certain investments may require specific investor qualifications, which not all individuals may meet. Any funds or companies discussed are not a recommendation or endorsement. Guests in the podcast might be actual clients, but are not compensated to be on the show, and their experiences are not representative of all relationships, which might differ substantially.